Right, good morning all, good morning, good morning. It is George and I'm going to be talking to you about price action trading this morning. Just want to check that what you're seeing is an opening slide, the FX market, price action trading. Yeah, that seems to have come through quite happily. I can see it on a spare monitor here. Brilliant, brilliant. Right, okay guys, price action trading. As you know, I am not overly keen on lots and lots of indicators. Right, well look, we're just going to look at a little bit of theory to start with, guys, and Robert will get round to looking at the actual markets and see if we can gaze into the crystal ball and see if there are some words of wisdom that will actually come out there. So first of all, guys, let's just take a little look at price action trading and what sort of things that price action traders are looking for. Now, what they're not looking at are oodles of indicators. Now, I do from time to time use indicators, but I don't get carried away. I don't like to fill my screen with lots and lots of squiggly lines, which can very often get in the way of the price charts themselves. So what I do like looking at, I like looking at both of these. I like looking at conventional bar charts where we've got the high, low, open, close, and of course I do also like looking at candles. And it is candles. That's great, Dudley. Glad to hear it. I'm with you on that. Candles and bars, well, I use them interchangeably. I do like to look at them both. And when I'm looking at candles, then what I'm looking for are what I consider to be some of the most important one-bar formations, first of all. And my very, very favorite is a hammer. Now, a hammer's got to appear in the right place. Now, a hammer has got this long tail, got a small upper body, not too bothered about the size of the body. It's the tail. I'm very much a tail man. I like to see long tails. The longer the tail, the better. Some people call them shadows. Others call them wicks. You know, I just happen to call them tails. Now, a hammer's got to come in the right place. A hammer is only any good if it appears after a number of down candles. So I'm looking for as many down candles as possible, but at least 3 down candles before I'm going to really want to trade the candle that comes after it. Now, the opposite of that, of course, is the shooting star. Not quite so reliable. Again, it's got a long tail. Really important. The longer the tail, the better. I like really long tail shooting stars. And I like multiple shooting stars, and we're going to look at combining some candles in just a second. Now, this next one is really interesting. Long white and long black periods, or whatever color you're using. The white one is an up, the black is a down in this case. But put the two together, and one negates the other. One negates the other. And we're going to look at a little bit of blending in just a second. Spinning tops, where we've got a little bit of tail above, a little bit of tail below, and in the middle there is a certain amount of trading activity that's been going on. And then, of course, a very, very close cousin is the doji. It is the doji. Right, well, I think we all know about those sorts of things, but what many traders seem to have a bit of a problem with at times is what is going on when you're looking at some candles and you think, I can't quite see the wood for the trees. What does all this mean? Well, very often, I find it very useful just to put, say, 2 candles together. Now, supposing that we're looking at this one, where we've got just over here, we've got this relatively narrow range candle, and then the next candle that forms actually goes lower, but then it goes higher. Well, if you blend the two together, you know, if you could imagine just merging the two together, if you drew them on a bit of cellophane, bit of acetate sheet, and you could actually just split the sheet and then just blend them both together, what do you get? Well, you get a hammer. Now look at that. Beautiful long tail, and one can imagine that these 2 candles formed after at least 3 preceding down candles. Blend them together, what do you got? well, you've got a hammer. Taking it just the one candle itself, well, that's an engulfing. Right, okay. The exact opposite of that then is this little pair of candles. And this one, we've got a bearish candle here. Blend the two together. What do we got? We got a shooting star. Right, okay, now let's go further. Let's just look at this little lot where we're blending three together now. And we've got a down candle, okay. And then there's this little doji that opens with a gap and it opens lower. Now that is strongly bullish. Strongly bullish just as a 2-barer, but make it a 3-bar formation where the next candle is popping up. Okay? The next one pops up. Blend all three together, and what do we got? We got a low right the way down here. Leave behind a really long tail. And then we got a small body. We got a hammer. We got a hammer. Okay, now you can also see that that little doji all by itself there. Oh, excuse me a second, the throat's getting to me. Right, is a little island reversal all in itself. Okay, and of course by a little bit of knowledge that that's an island reversal, and by blending the three together, we've got a nice little pattern that we're looking at. Right, well the opposite then, the bearish version, is over here, where we've got this little doji then that pops above. It doesn't have to be a doji, I mean it could be really any sort of candle. But the key thing is it opens higher but doesn't follow through going higher. Okay? Blend the three together, shooting star again. Right, let's just look at this little lot. Now this is now looking at the bottom here, we've got a harami. Okay, we've got a harami there, and of course by blending the two together, what do we got? Blends into a hammer, and then this one is the reverse of that. Okay, so we've got now a shooting star, and that shooting star then is telling us that this is a bearish combination. Right, let's move on. Let's move on to one or two others. Now, there are all sorts of individual candle patterns, of course, and the piercing line is really quite an important one. And where we've got a down preceding this little lot, then we get this up candle. We get this up candle. Okay, so it actually opens lower, right? Opens lower. That's a real key thing here. Opens lower, but it closes above the close of the preceding candle. Okay, then blend the two together. We got a hammer, right? There we are. That's the bearish version. We've now got a really neat little bearish version. Right, now let's look at a three candle combination here, very similar to the previous one, and this is again where we've got this little candle all by itself, opens lower, does not follow through, and immediately after that we've got a bullish candle, so we've got a hammer there, exactly the opposite. This dark cloud cover then is really a shooting star when you blend the three together. Okay, right. And finally, what do we got? It's rather like that previous little harami we were looking at, but this one is where we've got a little doji. We've got a little doji. Now, one thing that isn't shown here is that if we had a third candle, which actually went lower and then went higher than that little doji, we would have a doji sandwich. A doji sandwich. An old friend of mine, Billy, he used to trade, all he would trade on the bonds, he would trade the doji sandwich. He reckoned it was one of the most beautiful, powerful patterns that there ever was. Now then, what do we got here? Well, we've got another little 3-bar combination, but this time we're going up, and then we go up. Now this one is a little bit different to that doji star thing we were looking at previously, where price does continue on up, but then it just fails. Right, well, let's blend all of those three together. And what do we got? We got a shooter. Got a shooting star. And this one is the opposite of that. This is the bullish version. where we've got down, down, and then we've got a strong up, blend all three together, and what do we got? Well, we've got a hammer. So there we are, guys. That's this is one of the processes that price action traders can use. They can observe all of this very, very closely together. This last little combination here, we've got up, up, up. So we've got three up candles. Okay, the momentum on this up one is somewhat lower because of all of these overlaps. And then what do we get? We get a big, big, big engulfing, which completely engulfs the preceding three candles. And in itself, that is intensely bearish. And then, of course, blend the whole lot together. And what do we got? We got well and truly a shooting star. Okay, and a similar sort of thing over here with the hammer. And it comes back to that most reliable pattern. Right, okay, so that's just taken a little look at some of the things that I like to look at. I like to be aware of what is going on there. And this one that I know that some of you guys have actually seen this one before. This is a standard multi-point reversal. Now, it's called a 1, 2, 3, etc. There are very, very many variations on it. But what I'm always looking for, I'm always looking for potential reversals in the market. Okay? Potential reversals in the market. So wherever there has been a downtrend, as there has been here, price has been coming down, 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 down. Eventually, it does not go any lower. Price then attempts to go higher, then it comes back for a correction, forms a higher low, right? So chances are we've actually drawn a little trend line and we've got a higher low, and then price moves on up. And as price moves on up, then it forms yet another peak here, number 4, number 5, number 6, number 7, number 8, number 9, number 10, number 11. And it's only after point number 11 that this really does take off. So I'm always looking for reversals. First of all, I'm looking for the 1, 2, 3 with a higher low. And by the way, we were looking at a 3 candle combination. And look at that. If ever we had one there, we've actually got a superb little 3 candle combination there, which is intensely bullish. And of course, that did prove the point there. Right, let's move on. Let's just look at, this is the CAD, by the way. These little multi-point reversals got a nice little sort of whipsawing around here, but highly tradable. Right the way down here, price just collapsed on down. What did it do? It formed a higher low. And then yet another higher low. We got 0.1, 0.2, 0.3, 0.4, 0.5 take off with a little bit close together, but just see that candle? That completely engulfs the preceding 2 candles, and it is intensely bullish. Okay, it's intensely bullish. All intents and purposes, you can look at that as a 3-bar combination and completely ignore the preceding 2 candles. Right, price runs on up for a very useful, profitable move, and it comes to an end. What does it come to an end with? Another little multi-point reversal. 1, 2, 3, 4, 5, collapse. On down it goes. Right, now then, let's just consider for a moment an indicator. This is one of the indicators that I occasionally use, and it comes into its own. It comes into its own. Well, I trade the majors. I trade the majors, Gino. I trade probably cable more than anything else, closely followed by the euro, and then closely followed by things like the euro Jappy, the Australian dollar, and I have to say that this is one of my sort of great favourites is the Japanese yen. It's not particularly brilliant at times on technical analysis, but it does set up some really nice moves. Now, the reason that I will use something like a fast or slow stochastic, a slow stochastic I prefer, is where things are in a trading range, and this Jappy well and truly in a trading range, and it can be very, very useful when price comes down to the extremes to see, look at this, comes to an extreme, we've got then the stochastic which has gone to an extreme, and then it moves on up, okay? It's good for picking the reversals, and that's what I'm looking at. I'm always looking for reversals. It might be a reversal of the trend or a trading range as this is. okay, as this is. And then away we go. Gets up to the top, and that relates to a very nice little divergence play here. Notice the peaks. The second peak there is lower than the first one. Relate that now to the price, and the price has actually gone higher. So that's really telling us that this has not got enough oomph to go and break those previous highs. So on down it comes. Right, so there we are. That's just looking at those. Now, to answer that question, Johnny, I really haven't got a target. The target is going to be, there we are, next slide up. The target is going to be the reversal, okay? When and if there is going to be a reversal on the move that I've taken, then that's what I'm going to take my cue from. Now, I don't know if that's going to be 5 pips higher or if it's going to be 500 pips higher, okay? So, you know, there are a lot of textbooks, there are a lot of people talking about money management and so on, and they say, right, well, you know, your target's got to be, you know, you ain't going to go into the trade unless it's a 3-to-1. You know, you risk 10 pips to make 30, or you risk 100 pips to make 300. Well, I can never tell in advance exactly how many pips this thing is going to run for. I find that very, very difficult to do. Very difficult indeed. So I'm just looking for price action. I want to see what price is doing. And provided price is running in a trend, I want to stay with that trend. Right, now let's get on to some reversals. I just love these reversal patterns. This is a standard Gartley or multi-point reversal, right? 1, 2, 3, 4, 5. That multi-point reversal we were just looking at will form something like this. This happens also to look just like a Gartley or a bat pattern. We're going to look at those in just a second. We'll look at some of those on the charts. The ABC feature as well is picked up here. Anyone who follows Elliott Wave will know all about ABC, and that will run from 2 to 3, that would be A, nice little correction up to 4, caves in, runs down 4 or 5, which so often is exactly the same length as 2 to 3. So there we are. That's a classic little bit of ABC. And there it is. Of course, links up with Fibonacci that I use extensively. Right. So let's just look at the rules on the proper nomenclature. Oh, that's quite a word, isn't it? Nomenclature. Right. We've got a low here. We can pick a low, a significant low. Now, this might be in the context of an uptrend, or X area just might be at the end of a downtrend. It's really immaterial. What we're looking at is from X onwards. So not too worried about what has been going on to the left. But anyway, price moves on up. It comes on down for a correction. It rallies, okay, on up to C. Yeah. Then it comes on down to D. And for this to be a correct Gartley, B is going to be 61.8% of X to A. All right? Doesn't really matter where C goes, but the next important thing is that D has to turn at this very, very important level, which is 78.6. And there we go. Yeah, absolutely. Absolutely, yeah. There we go. And here we are. This is a nice little bearish example. So look, we picked out X there. It doesn't really matter that we got a preceding peak, but we pick out X. All right. Price moves on down. Up it comes to B, then a C, and then up to D. D is in the 78.6, and then down it goes. Crash, 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 crash. Target areas, well, I put target area 1 there, but my target area, first target, is going to be in the region of the previous low, which is so often where price is going to attempt to come back. But it attempts to come back, fails, on down, target area 1 is going to be this area here, A, and then the target area 2 gets into Fibonacci areas. Absolutely right. Yeah, everything's linked up. Everything's linked up. Right, yeah, absolutely. Why not? A, B, C, D, E, F. Well, what's that forming? It's forming a full five-wave pattern. A full five-wave pattern. That's why you very often see them. Now look, this is an example on Google. You'll see it in any market, doesn't matter what it is. We'll see them on the actual Forex charts in just a moment. But look at this. This is another standard pattern here where price comes down, X to A, and then we've got this nice little measured move reversal, pops up there to 78.6, and down it goes. There is always another opportunity with these. Look at that. The trader wants to get in pretty close after D, but there is always going to be a correction that runs back to this area, okay? Or at least there's going to be some form of correction. And that is the lower risk entry there. Run on down, target 1, close part of the position, little bounce back up, not too worried about that. Start to bring the stop down, so it's a stop profit, and down we go. Down, 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 and so on. Right, well, stop points are dead simple. Once there is a correction, okay, as there is to here, that's where stop number 1 is going to go. So I want to be short, okay, following that shooting star. Yeah, following that shooting star. Price comes on down. Once price breaks the preceding low at that point, okay, and then puts in a little correction, a little rally correction, and moves lower, the stop comes down to that level. Yeah, absolutely. If I miss that entry at D, that's my second entry. Right? So, supposing I got short at D, the stop is going to be there. Right? Price will go on down. It'll then rally on back up to this area. That gives me another opportunity to add to the position. Oh, I don't want to risk too much. Oh, I don't want to risk all that. No. If it then moved on up beyond that 78.6, this Gartley is not a Gartley. It hasn't worked. The chances are that this is just a continuation. So I don't want to risk a shed load of pips. Now, I just want to see it now rolling over. On down it goes. And as it goes to a new low, right, then I'll bring the stop down to the preceding high. As price drops down below here, okay, I'll bring my stop profit down to just above the rally high. And so on. Comes down to target area 2. Might want to take a little bit more profit off the table. Rallies back up. Price then moves on down. As it goes to a new low, that's where my stop comes to. And the stop comes even further down. Eventually that stop's going to be taken out. There we go. Right. So, that is a Gartley pattern. We're going to look at one of these in practice in a second, but let's just move on, look at one or two other bits and pieces. We've got yet another one here, and what we don't really know on this one, we've got X to A, alright? We've got the A, the B, the D, and is this thing going to follow through on the downside or not? Well, if it goes above D, it's failed, right? But if this now moves on down, then absolutely great, it's going to follow on through. So any move back above D, it's a failed pattern. It's a failed pattern. Here we go, got a nice little bullish one, X to A, B, C, D, alright? 78.6 is the key level. If it breaks 78.6, it's not a Gartley. Price then takes off, and away we go. Target area 1, target area 2. Just follow the stop on up, and it locks in the profit. Right then, guys, let's go and look at some charts. Now, bear with me a second. And the very first one we're going to look at is this little pattern, and it is the Jappy. Excuse me a second, throat's getting the better of me. Right, here we are. Now, this is a 240-minute chart. I'm assuming you can see this, guys. Right, now you should be able to see this, okay. What we're looking at then is the Jappy. It is the USD JPY pair. Each one of these candles is 4 hours or 240 minutes. Each one of these little chain lines we're looking at is changeover in the day. Now, this pattern has been going on for a little while now and has yet to prove itself. So what do we got? We've got point X right the way down here at the bottom. And this was the day a couple of weeks ago when the Japanese decided to intervene and buy the US dollar so that they would weaken their own currency. It's something they do from time to time. The reasons for it are to do with, well, two things. Domestic economic reasons. Number one, it makes their exports abroad more competitive. It also increases the cost of imports. Also, there was a little bit of chatter that they were wanting to make a point to the Chinese. But by the by, don't really worry about that at all. Just look at the pattern. So we get this big move up. Price then came on down to B. All right. So it came down to B. And this one came down to a level that it then shot up to C. But then it came down. And I'm going to put the grid on here because what you're going to see in a second, okay, is that B was not actually quite down there at 61.8. It was less than 61.8. If it is less than 61.8, it turns into a thing called a bat pattern. And the level at D for a bat pattern is somewhat lower. It is down here at 88.67%. Okay? Now then, what has actually been going on? I was looking at this at the weekend, so I just drew in this little zigzag line, and price popped up, it came down, and it popped up again. So this level at D is a real important level. Look at it. We've got today, it popped down to this level. Yesterday, Friday, Thursday, so this is an important level. Now, it's entirely possible that what we might see is this whole thing just cave in and price go below here and it'll resume its major downtrend. But it's also possible that there may be some buyers of the US dollar coming out of the woodwork in this region to start pushing price on up. So let's just bring that now down to something like a 30-minute chart, right? And what we can see here is the price action today then attempted to go higher at 83.90. It came hammering all the way down. Price action traders then look at this and see, that little candle there, that's an harami. Okay, that is well and truly an harami, right? Now, if we were to blend together the candle before that, plus this harami, plus the breakout candle from the harami, plus this next one, well, what do we got? We've got quite a bullish candle. It also bounced up from this level where there is this great big conglomeration of prior price action, which has been support in the past, and at the moment, it's recognizing that support. So the big question now is, will price rally up strongly or not? Or not? Now then, I'm looking at this pattern. It's a possible pattern. It just might go and fail. And at the moment, I have got a position on this one. Now, if it fails, fair enough. We just look at much more downside overall. But of course, there is the big danger that Japanese just might come in and intervene yet again. We end up with another one of these really strong up days. Right, let's go look at something else. Let's go and look at something else. Right, yeah, no, Jack, no real maximum. A couple of candles, 2 candles, 3 candles, and very often by getting as far as 4 candles, maybe the last couple of candles are really telling the story whether it's bullish or bearish. Now, let's have a look at the DX. What we got down here in terms of an indicator is an indicator that a partner of mine has put together a brilliant indicator. This one's called the Swing Chaser, and it gives a very, very good impression as to how overbought, oversold things are and where there are divergences creeping in. Okay, and as we can see, price action at the moment is very, very, very extended on the downside. So just in the interest of having a little bit more space on the chart, I'll just disable that. And I've marked up a whole series of the blue band areas where there is potential support. Now this is based on price action, it's based on fibs and so on. And yeah, we'll look at that in just a second, Robert. And this area down here at 78, all right, is a real important area. Now you can see the fibs. What I'm going to do, I'm just going to draw 1 or 2 lines on here. So I'm taking this all the way up, right? Price then comes on down. Where does it come down to? It comes down to 61.8. It then pops up and then all the way on down to here. So and put the numbers on, the letters and so on, but this is X right the way down here. The top of the chart then, right the way up at the top, is going to be the A. And then we've got B coming all the way on down here, C, and then D. So this thing is, in actual fact, a Gartley pattern, right? Just like those that we're looking at in practice. And the Gartley needs to turn at 78.6. That's exactly where it is right now. Now, I don't know if anyone's told the dollar index that this is a Gartley, but price action so far today has actually engulfed price action of yesterday. Now, that is usually intensely bearish. But what we're actually looking at now is something that is an engulfing, but it's in the wrong place. It's in the wrong place. Boyke, I keep it on the same time frame. On the same time frame. Okay? I may well look at other time frames. I mean, for instance, on this particular chart, it's actually quite useful now to go and look at the lower time frames and do a similar sort of exercise. Okay? So what we've actually got here is that what is the rationale behind these terms? Oh, Mapos, that is a question. The rationale. Now, what do you mean by the rationale? Is it the rationale from a technical perspective, or is it what is actually causing these turns? Well, you know, I suppose we could look at it in 2 different ways. The rationale for looking at this as a technical pattern as we currently are is purely that if this pattern works out, which means that price has got to go higher from here, then we can start to look at the target areas, which will be 84. Okay, it'll be 90, and it'll be Fibonacci multiples above that, all right? But what is actually causing price to pause in this region will be a whole load of things. Absolutely a whole load of things. Not least of all, the fact that price actually got down to this level before. There will be traders who didn't get in on this, and they're thinking, right, it's come right back down to that level that I was bullish at before. I'm still bullish. I'm going to buy in this area. All right. It could be some interesting economic announcement that we've not yet had. It could be Ben Bernanke standing up and saying something really quite interesting, such as, we don't want a weak US dollar. Now, I actually doubt that he's going to say that, because I think the US are very, very happy with a weak US dollar. But when there is a pattern doing what this pattern is doing, then I'm going to get really quite interested in it. Right, now then, looking at different time frames, coming all the way down in the time frames. Yeah, absolutely. Yeah, there are a lot of profits on the shorts at the moment. So yeah, short covering. Now these harmonic patterns are absolutely brilliant, but just look at price action today. This is the dollar index. Okay, this is in real time. At this, in the mornings, there is very little activity that goes on the dollar index. It perks up after lunch, UK time that is. That's of course when the Americans are getting to their desks and starting to really get quite interesting. In about an hour's time, then we'll see that this is all sort of kicking off and things are actually moving. But this pattern at the moment, I don't know if you can remember it, but forget the moving averages, guys. That just happens to be on this chart. I suppose they've crossed over there, golden cross. But what is actually happening here right now is that price has bottomed and it's putting in, you got it. You got it trying. It's a multi-point 1, 2, 3 reversal. 1, 2, 3, 4, 5, and, this could just follow through. So we looked at the macro, which is the daily view, coming right down to the micro, which is the tick chart, and at the moment, we are looking at a bullish chart. I suppose we ought to switch this over to candles for a moment. Let's just switch this over. There we are. We can see it displaying the candles. And so we've got a number of bullish candles here. First of all, this little one down here, by blending these three together, look at that. We've got a bearish candle that then opened just fractionally lower, but did not follow through, followed by a very strongly bullish one. Put those three together, what do we got? Well, we've got a nice little hammer-looking candle. We've got a nice little engulfing there of two preceding candles, so that makes that a very strongly bullish candle, and so on. So there we go. Right, now, you guys wanted to look at, where would you enter the trade? Let's get back to this. Right, well, this candle, alright, this white candle, which is an up candle, which is completely engulfed, alright, the preceding two candles, would be my entry candle, the candle that followed that bullish candle is the entry candle with a stop, in this case, just below 78.20. Now that stop would only move up if and when price surpasses this previous high that's been put in. So price has got to go above there before I would bring the stop any higher. So let's just go through that again. Let's put a couple of lines on. That blue line, hold on a minute, it's a little bit slow, there we go. That blue line, above there is my entry, alright? On that candle that breaks that line. The stop goes just down there, just below 78.20. 78.19, 78.18, 78.19, giving it just a little bit of wriggle room. Yeah, the candles for me are they're the key. They are my triggers, right? Now, if price goes above this little high that it's put in, then this line moves up to just underneath that correction. And that's what I will be looking for all the way on up. I'd keep moving that line. It hasn't done it yet, so that's where that one has to stay. Right, guys, let's go and look at, let's take a little glance at cable first of all, shall we? Right, now then. Let's start off with a bit of a macro view here. Got various lines. So this is the daily view. Put a little bit of space between the candles. So what we've actually seen then is that in early September, price then just put in this bottom and turned the corner. Notice the intensely bullish candle as it moved on up, right? Long tail, long body engulfs the preceding candle, right? So that is a trigger candle. We also will see that by putting a trend line on down through there, in fact, that's where the trend line goes. Trend line gets broken. We've got then a 1, 2, 3. We've got the number 1 at the bottom there, number 2, number 3, and price then engulfs. Right? Little line goes across there. You see where it engulfs? So anywhere above that blue line is a buy. And of course, ideally, you want to get in at the lowest possible risk place. So, you know, you might not want to trade the breakout. You might want to wait till you've got the pullback and trade as price moves up out of this pullback, right? On up it goes, and then you just keep moving with it. Now, what we haven't seen yet, this is the correction on the high, but what we saw towards the end of last week, in fact last Thursday, cable decided, for whatever reason, that it was going to engulf, and it engulfed 1, 2, 3 candles, all right? Very, very, very bearish, that one. Very, very bearish. So let's string together that candle, the big bearish candle, plus these other little candles, and what do we got? We've got a big shooting star. If we blend together 1, 2, 3, 4, 5 candles, big, big shooting star. Very, very bearish, okay? That is only going to get negated when and if price can get above, let's put a line across, the tail of the bearish candle, right? Got a long tail. Price is putting in a little bit of a test right now. And price action today, okay, price action today is very, very bullish. Very bullish. Because it went down and it's gone up. Now it's worth just coming down on the time frames. Let's just bring this right the way down then to this thing. Guys, I've got to just knock these off. You know, apologies to people who like moving averages, but you know, they had to go. Right, let's just look at price action this morning. There we are. Price actually hit a low down there just below 8:30 UK time. Moved on up really, really very, very strongly. Okay. But has since run out of steam. Well, it's no surprise that it shouldn't do so at 159. And relating to that chart we've just been looking at for the dailies, it's getting up in the region of the high of that big, big last Thursday engulfing candle. So it's going to have a bit of a problem there. So would I want to trade this long? No. Not until such time as it's broken the tail of that preceding candle on Thursday and corrected. All right? That would be my rule for that one. There is that potential supply area there over on the left. Quite right. Quite right. So at the moment, I wouldn't want to be trading this one on the bull side. Not yet. Not yet. Okay. Let's just bring this, say, down to a 30-minute candle. Right. Look at that. We've got now that last Thursday peak, which is pretty close to where this one is, where price has popped up to this morning. So I would want to see price. I'm not trading this today, by the way. I would want to wait till this has moved up above and then corrects. It's got to prove itself above. That for me hasn't happened yet. At the moment, it's still in danger of a sell-off. Okay. Despite the fact that we've got a strongly bullish day today. Now let's just have a quick look at the euro. Let's do a macro to micro on this one. Now this is getting really quite interesting in that sentiment on the euro changed on a sixpence, and it changed there towards the end of August. Set up a beautiful little multi-point reversal. price has then just moved up, inexorably going on up. Where has it gone to? Well, we can pop a line across here, and that line links up to previous peaks. Okay. Now we've got some fibs just above here, and what will need to happen for this thing to move on up to 140, which it seems to be very keen on getting to, is that will we get some form of engulfing? Will there be something rather like we got last week with this big engulfing? Another engulfing on the way. Are we going to see that today? Well, we just might. We just might see that today, or not, as the case may be. Now, bearing in mind that the average true range of the euro is around about 150 pips. Now, average true range is the distance that it travels from a low to a high or a high to a low in the day. Well, let's go down now to the tick chart, and let's see, we just pack in a little bit more data here. And there we are, 4:30 in the morning. It was down there at 136.40. Add 150 pips to that, what do we get? And it's going to be up in this sort of region. So, has it now done its ATR for the day? Well, more or less. Should we expect another strongly bullish up move today? Only if we expect it to be a really super exceptional day, far surpassing the average of any typical day. So we've got to be a little bit careful with looking at the bullish side of this chart. Okay. If this were to now start to create a reversal, which it certainly is, we've got a 1, a 2, a 3, a 4, and a potential 5, then this thing could tank on down. So yeah, trying. The ATR is, I reckon, it's vitally important. It's one of those things which will get you out of trouble, and it tells you how much potential is left in the day. Now, we're talking a little bit earlier about targets and so on. Well, that is something that you can use as a target, and if something has gone through, say, 100 pips, when it normally only will go through 140 pips in a day, well, what am I looking at? Only another potential 40 pips. And beyond there, it needs to be a super exceptional day. Now, the ATR is only an average, of course, and it's entirely possible that price will decide that it's going to go considerably above that in a day. But if it's completed the ATR, or pretty close to, within, say, 75-80% of the ATR, I'm not really expecting anything more. In fact, what I would really want to do is to look back and expect that it might reverse. Now, at the moment, just look at this. Fib is not going to help us all that much in relation to this because it's now gone right the way up to a previous peak. And this little conglomeration of price action is really very, very important. The high candle, all right, it's got a long tail. It's got a long tail. So that is a bearish candle, taking that just as one single candle. Okay. This particular candle attempted to go higher, but left behind a long tail. The next candle is an Hallmey, bearing in mind that these are 30-minute candles, and the current candle is an Hallmey inside another Hallmey. So this one is smaller than that one, and that one's smaller than the one preceding it. Whichever way this one breaks could set us up for the next good move. So if we get a Hallmey break on the downside, then some form of correction, which has got the potential to bung it all the way down to where it started from this morning. But if it broke on the upside, then I guess that we would probably find it not wanting to get too much above 138. So there we go. That's that. Could be a flag formation. Absolutely. Could be a heart. Absolutely. It could indeed. It could indeed. Yeah, Robert, if you want to just drop me an email, I do private coaching, and if you drop me an email, support@clickevents.co.uk, you can get in touch with me. But there we go. On this particular one, bearing in mind the comments that I've just made about the ATR having been more or less completed for the day, I would only trade this on the downside. Okay? I would only trade this on the downside as an intraday trade today. Right, so that's had a little look at that. Now, Boyke, you were talking about an 89 tick chart, so I'll tell you what we do. What we're going to do, we're going to put alongside, see these two? Let me just get rid of the volume out of there. I'm going to put a 3-minute chart on there, okay? And then on this one, let's just turn them both into open, high, low, close bar charts. And you can actually see the answer there. That will press the right icon. Okay, right, now let's just look at these. And what we're looking at is a very similar pattern. Let's just snip that in a little bit too far out. That's about right. So, in answer to your question, at this sort of time of day, then more or less 89 ticks is around about sort of 3 minutes or so. Okay? So we're looking at more or less the same sort of thing. Now, in the middle of the night, during the Asian trading range, when things are a little bit quieter, okay? When things are a little bit quieter, then what you'll see is fewer tick candles, but of course you'll see exactly the self-same number of time bars. Because time is time. I mean, time just wanders on. But activity is activity. If there's no activity, then you'll see very, very few of these. And that's why when you look at the dollar index, oh, let's do just that. Let's do just that. Here we go to the dollar index. All right. Now, let's just get rid of some of those lines for a moment. Okay. Chain line there is the changeover from the day. All right. So from there to the right is the extent of the actual price action during the day so far, which is not a great deal. Relate that now to the time, and of course, you know, this is time, and that's only from 9:30. So it's showing that the dollar index doesn't trade much. It doesn't trade much during the UK morning session, okay? But it really gets moving, and it'll get moving after the bond market opens at 1:20 UK time. Right, guys, there we go. We've had a nice little roundup on the markets. We looked at some price action trading, and there we go. So with any luck there, guys, you've got that email address there, Robert, support@clickevents.co.uk, and look forward to being with you guys, and I look forward to being with you this time, well, not this time, but 11 o'clock on the first Friday of November. And right, okay, doke. Right, okay, guys, I'm going to sign off right now. It's getting time for me to get a sandwich ready, and enjoy your trading, and I will be with you again on that first Friday in November, Tuesday in November, not the first Friday in November. The first Friday in November will be a non-farm payroll day, but it is Tuesday, the 2nd of November. All the best till then.